Hello everyone, today we'll be looking at how we can trade gold XAUUSD on the 1 hour time frame using price action and ICT. Now I have the gold chart 1 hour time frame, and the first thing we need to do is to identify the trend. The initial trend we have on the chart is bullish trend. Bullish trend initially. What do I mean by bullish trend? Let's take this as a high. Take this as low. And this as higher high. And this as higher low. I will take this as higher high, higher low. And we have this as higher high. Okay. And this as higher low. And I will take this as higher high. This as lower low. Lower high. And we have lower low. Okay. Now the trend here is bullish trend. And bullish trends is characterized by higher high and higher low. So anytime you see the high, the low, then the higher high, this particular high is higher than this high, and this low here is higher than this low. Then you have another price making another higher high. This high is higher than this, and this making another higher low. This goes up. So you have these characteristics where you start to see higher high, higher low, higher high, higher low. That phase or that particular section of price or that particular formation by price is called uptrend or bullish trend. So the first thing when you come to the chart is as price from a trend. Find that out first. And you wait for range. Now this is the range. Range is where you start to see price from higher high, higher low, mixed with lower high, lower low. That particular area where you have higher high, higher low, higher high, higher low, higher high, lower low, lower high. Where you start to see higher high and lower low. That area is called range. So these are range. This is the area of range. Price has been ranging around here. So the first thing, look for initial trend. Look out or identify initial trend, right? Second thing, identify following range. Okay. Then the third thing, wait for range breakout. Okay. Now you have your range breakout happen here. Higher high, higher low, higher high, higher low, higher high, lower low, lower high. At the point of lower high, if price breaks this first lower low, when the trend shifts from bullish to range, by the time you see a break of the lower low, then you have your breakout. Wait for range breakout. So the idea is the price breaks out, price is likely to, if it breaks out, likely to start a new trend. This the old trend, bullish trend. You have the range, then you have the breakout, and then you start to anticipate a new trend, which is most likely a bearish trend. But don't get it wrong, don't get it twisted. You might see a breakout expecting that you have started bearish trend. The price might surprise and continue in the direction of the previous trend, which is the bullish trend. So there is no certainty that price is going to go down. It's not certain. And the fact that it's not certain is the reason for stop loss, risk management. So identify initial trend, identify following range, wait for range breakout. Then point number 4, identify pullback. Okay, identify pullback after range breakout. Now this is your range where you have higher high, higher low, and then you have higher high, higher low, and then in that particular phase of the chart, you see lower low, lower high. So this particular phase, and this particular phase, you only have higher high, higher low. And in this particular phase, you can see mixture of higher highs and lower low. So this is a range phase, consolidation phase. In that particular phase, the moment you see price breakout of the lower low, then that's your range breakout. So you need to identify the range breakout. That is key. But like I said earlier, you might have range breakout and price might surprise you. Price might just give you a false breakout. You need to be careful of this. You need to be careful of this and avoid false range breakout, because that happens a lot. And I said that's why you need to put stop loss. So after wait for range breakout. If that happens, identify pullback after ringback. So after this ring breakout must have happened, then look back. Was there a pullback before seeing this ring breakout? Of course, this the pullback. And that takes us to the next point. Allow break of structure. Point number 5. Allow break of structure to occur. Now these are structure, lower low. Then this particular point, this particular bearish candle is where you have your break of structure occurring. Break of structure occurs when you have this solid bearish candle form, or where you have this particular bearish candle form and then closing below this previous low. That's our break of structure. So allow break of structure to occur. Once that has occurred, of course, that also forms part of your range breakout confirmation. Then the next point is stop loss equals distance of pullback. Now your stop loss to enter your trade, you can enter your trade at any point of breakout. Okay, but your stop loss is the first thing, which is risk management, is the first thing you need to set up. And to set up your stop loss at any point after entering the trade, stop loss equals distance or depth, okay, in pips of pullback, of price pullback. Now this is the depth of the price pullback for this particular explanation. Price pullback, the depth is 4366. 100 pips, 200 pips, 300 pips, like 340 pips from this low to this lower, from this lower low to this lower high. You have like 340 pips. So that's a stop loss. And once that is identified, you enter your trade anywhere around here and mark up 340 pips as your stop loss. Now I woke up and I saw price has already given me a breakout, and I entered around here, and my stop loss is still equivalent of the depth of the pullback, right? From here to here, that's my stop loss, 340 pips or 350 pips or whatever. Now the next point is enter after a break of structure or enter after second pullback. So to enter the trade, you can enter the trade after break of structure or after second pullback. Okay, so you can enter a trade here after this break of structure, after the closure of this bearish candle, or after the closure of this bearish candle. You can enter your trade anywhere around here. but you know your stop loss is 350 pips or 340 pips, right? And then you have second pullback here, but it's a very small pullback. You can enter your trade after this second pullback. You can enter your trade anywhere around here, but you must ensure risk management, which is 350 pips, equivalent of this distance. So that's that. Now for your TP, point number 8, take profit may we risk reward ratio 1 to 2 or 1 to 3, depending on your appetite. Depending on your appetite. So if the depth of the depth of the stop loss, this is the depth of the stop loss. This is it, right? And I enter here. So twice that depth is going to be my TP4 ratio 1 to 2, risk reward ratio 1 to 2. So the risk is 350 pips. TP will be 700 pips. But if I decide to go for risk reward ratio 1 to 3, that means the risk is 350 pips. And the reward will be 1050 pips. Okay? Depending on how I want it. But if we expect price to really go down, you might be seeing price drop as low as 4,000 and possibly 4,078 or possibly 4,039. We expect complete reversal, but this is a key area where we expect price to bounce 4250 level because of this newly formed trend or developing trend, bearish trend. Still developing. You might see a sizable pullback before price drops to 4250 level. And price, because market is full of uncertainty, price might decide to go back up. The fundamentals play out, price go back up and trip stop loss. So it's not a guarantee that newly formed trend, let me dive in and then make profit and continue to follow price down. Or if price reverses, that's why you have your stop loss. So are you willing to risk 350 pips? That's the first question you ask. If you don't have much in your account, maybe a small account, I can't handle 350 pips. Just scale small profit or scalp off small profit at a time. So another thing I like to explain is how do you know when price has formed higher high, higher low, when price has formed the swing high, swing low, swing high, swing low. How do you know that, oh, the swing has formed? Oh, now I have lower high. Okay, I have lower low. How do we know that? So, swing high, point number 9. Swing high or swing low equals after second candle formation. Alright, so if I zoom, let me zoom to the beginning where we have the high. This is the high, this is the low. So we have a high here, price forms a high here. So how do we know we have a low? Right here we have a low because we have price has been giving us 1, 2, 3, 4. We have 4 bearish candles here formed, but we have only one bullish candle. Then we have another bearish candle, making 1, 2, 3, 4, 5. 5 bearish candles with just one bullish candle in between. So the moment we have 1, 2, 2 opposing candles formed in this particular downtrend or a down leg, let's call it a down leg of price. When we have 2 opposing candles, 1, 2, then we have our swing. So this particular place is a swing or is a low. So I'm going to call this low or internal low, whatever case you want to see it. Then we have a low where we have 1, 2. Oh, price is going up. Then suddenly we have 1, 2, 1, 2, 2 bearish candles. Remember we have 1, 2, 2 bullish candles. Then immediately we have 1, 2, 2 bearish candles. Then this is a high. So this is an internal high. Remember we started with a high as our structure identification or structure naming. Then we have a low. Then we have another high because we have the formation of these 2 candles, opposing candles. Second candle formation is the second candle formation. Then there's a high. But we have high here. Now we have a new high. This high is higher than this high. So we call this lower high. Lower high. Because this new high, we can see the new high after this second candle formation. But it's lower than this high. That's why we're calling it lower high. So we start to have 1, 2, 3, 4, 4 bearish candles. And the moment we have 1, 2, second candle formation of this opposite bullish candle, then a low is formed. So now this low is lower than this low. So we're going to call this lower low. So it's an internal lower low because this particular low is lower than this low. So we have just one bearish candle, not 2. If we have 2, then we go with the step number 9, which is second candle formation. But we have one, but that one envelopes or is like an engulfing for these 2. So obviously it's going to give us a lower low. So we have lower low here. Now this lower low is lower than all these previous lows. So it's going to be our external low. But all these previous lows are within this particular leg. Okay. Leg as in from this area all the way down. Meanwhile you have internal lows, internal highs. So this is a lower high because of the engulfing. It's going to be our lower high because this high is lower than this high. And this high is also lower than this previous high. So we have lower high, and this one is even lower than this lower high. So we have low, lower low. This low is lower than this low. And we have another lower low. So there's no other lower low here. So this will be our external lower low. While this previous lower low is still within the leg. So this will be our internal low, internal low. Then 1, 2. Just one small bearish candle, not two. Maybe we have two, we might call it a high or lower high. It's just one internal bearish candle. So we continue three bullish candles, then we have one. But this is a doji. There's 4 bullish candles, then we have this engulfing. Okay, so we might call this high and this low. So but this high is going to be a lower high. Lower high in the sense that we have an engulfing, making this point higher than this point. So then we call this higher low. Because this low is higher than this low. Then we see a breakout of this lower high, and then we can see price going up, 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 up. No second candle formation on the bearish side. Just one candle, and then we can see price close higher. And if we have this one candle and we see price close lower, like an engulfing, meaning we have this one candle and then another bullish candle, then we see an engulfing, then we have another higher low. So price keeps closing higher, showing that the bulls are winning before we have this second candle formation on the bearish side, giving us this high, external high, and we now call it higher high. Higher high in the sense that this high is higher than this high. All these lower highs are internal highs. So we look at the external, we look at the external. So this will be our external high, and this is going to be our external low. Because this low is lower than these two lows. So that's how you map the higher highs, higher lows, higher highs, higher lows. Until you get to this point. At this point, you have a lower low here. And then second candle formation. This is an engulfing bearish candle. And the bears are winning. We can't see second candle bullish formation. No second candle bullish formation. The bears continue to win until this particular point. Just to see this particular point, you have second bullish candle formation. So you have an external low here, then you have another low here, lower low. But it's not prominent because the second candle formation on the bullish side, they are small candles. It's not really visible. It's not really visible, but the high is still a high. It might not be much elaborate, but still a high. So call this lower high. Now this lower high can be taken as our second pullback. That's where I'm going to. It can be taken as our second pullback. This is the first pullback because you have this first candle bullish formation after like 8, 1, 2, 3, 4, 5, 6, 7 bearish candles for a drop. Also have this first lower low. Then you have 1, 2 bullish candles. The moment you see the closure of this candle, and it's a low. And then you see pullback. You call this a pullback because 1, 2, 3, 4 is a pullback. 1, 2 is a pullback. 1, 2, 3, 4 is a very visible pullback. Okay, then you see the break of structure here, happen here, where this low, this close. If this close is lower than this low, that this is a break of structure. But if this is not really confirmed, then this can be our confirmed break of structure where we have a candle closure below the low. So these are second pullback. It's not really prominent, not really visible. And this is the break of structure of the second pullback. But this might turn out to be our second pullback, but my analysis might be wrong. Price might continue to go higher. Today is Friday, anything can happen. So that's the analysis for today on how to trade gold on the 1 hour time frame based on what price action and ICT is showing on the screen. So that's that for today's video. You can learn more on price action, ICT, on how to trade gold on the website www.beanfxtrader.com. Visit the website. Please like and follow the video. Thank you. See you in the next video.